Hello friends, how are you all? Let us continue international economics. This is the 15th video of this particular lesson. In this video, we are going to discuss what is the relationship between interest rates and the exchange rates. Okay, so how they are connected to each other and how movement in interest rate in India as well as in other countries will affect our exchange rate. Okay, so this is a very important concept of international economics, and we just need to understand the dynamics, okay, how they are related to each other, and then you will be able to solve any question that comes from this particular topic. Okay, in the past UPSC has asked questions on this relation, and therefore it is necessary to discuss it, right? Just like we have discussed the relationship between yields, right? Yields, the bond yields and the interest rates, okay, and also the rates of the US Federal Reserve, so how it affects the Indian bond yields, right? And so many different scenarios. So similarly, today we are going to study what exactly is the relationship between interest rates and the exchange rates. Now before we get into this discussion, we have to keep a few things in mind. Okay, so we already know this, but let us just make some assumptions and keep some things in mind, before we understand what is the relationship. So first of all, when we talk about interest rates, so interest rates here will mean, it means the RBI's policy rates, which ultimately affect other interest rates. Okay, so when we are talking about interest rates, it means the RBI policy rates. Okay, so what is the RBI policy rate? It is basically the repo rate, and we know that all other rates like reverse repo, marginal standing facility rate, bank rate, etc., everything is connected to repo rate, right? And therefore repo rate is the policy rate, and when we talk about interest rate, basically we are talking about the repo rate, policy rates. So when the RBI changes repo rates, it ultimately affects all other rates, that is, the bank savings rate. So whatever the bank is offering on the savings, on the fixed deposits, etc., so all that is basically savings rate, okay, the bank that is offering. Then the yield of bonds, okay, so yield of bond is also related to the RBI policy rate that we have seen, etc. So every other rate in the market depends on the interest rate that the RBI is doing through its monetary policy. Similarly, when we talk about interest rates of a foreign country, it means the respective policy rates, okay, the respective policy rates of that particular government of that particular country. For example, in USA, the monetary authority is US Federal Reserve, okay, US Federal Reserve, and in short it is known as US Fed. Okay, in US it is called as US Fed. So, and the rates, the policy rates of the US Fed are known as Fed funds rate. Okay, so basically these are the policy rates of the US government. The second thing that we need to keep in mind is that money supply in an economy is a policy variable. Okay, therefore it is a given that is constant at a given point of time. Until now we had seen that in the money market, okay, in the financial market, we had seen that this was the demand for money and this was the supply for money. Okay, so this is what the normal market looks like. Here was the interest rate, that is the price per unit of money you have to pay, and here was the quantity of money in the market. Okay, so this was the equilibrium quantity, this was the equilibrium interest rates. However, in practical life, I had also mentioned this somewhere before, that the money supply, the money supply is decided by RBI, how much money supply will be there in the market. So it is a policy variable. If it is a policy variable, RBI decides that this much money is going to be supplied in the economy. So it is a constant, okay, that money supply is a constant for a given point of time. So that's why it is a straight vertical line, that is, this quantity is given, this is a quantity of money at any given point of time, it is a constant. And this is naturally the money demand, which is a downward sloping curve. Okay, so this is the money demand, it is downward sloping, because as your interest rates increases, the demand for money will go on. As your interest rate increases, demand for money will decrease. So that is a normal demand curve. Now you look at wherever this money supply, this given money supply and the money demand intersects, that will determine your policy rate. So RBI basically decides your policy rate, and RBI decides policy rate. And suppose, for example, if the policy rate RBI increases, so here is the policy rate, the RBI increases the policy rate, automatically this is the corresponding money supply that will be there in the market. Okay, if the RBI decreases policy rate, for example here, then automatically this will be the money supply that will be there. So here money supply is increasing, here money supply is decreasing, and that is how by changing the policy rate, RBI actually controls the money supply in the market. So we have to keep in mind that money supply is constant at a given point of time because it is a policy variable, and that determines your interest rate or the policy rate that is there. Then the third thing is that we have a managed floating exchange rate regime in our country. Managed floating we have already seen. So basically RBI allows some fluctuation in exchange rate but intervenes whenever the fluctuations are too high to maintain the value of rupee. So basically in the foreign exchange market also, basically this is the supply of foreign exchange, this is the demand for foreign exchange, say dollar, and here is the rupee per dollar exchange rate, and here is the quantity of dollar in the market. So basically we know that as per the market, this is the exchange rate. Okay, this is the market exchange rate. So RBI, for example, RBI decides that our exchange rate is going to be this much. Okay, RBI decided this is going to be our exchange rate. So RBI will allow some band. So some fluctuation in a given band. For example, 5% plus and minus. So it will allow a band of say 5%. So basically RBI will allow this much depreciation and this much appreciation in the rupee. So a rupee can fluctuate in between this value, but if it goes beyond this value, then RBI will intervene and it will bring it back to this band. So this is known as managed floating. We have already studied this, and we have to keep in mind that we have a managed floating kind of system in our country, because we are going to look at relationship between exchange rate and interest rate. We have to keep this thing in mind. Okay, now next thing we have to also understand that whenever there is a currency depreciation, for example our rupee depreciates. Okay, rupee depreciates means what? The value of rupee in terms of dollar decreases, that is depreciation. So what is the meaning of depreciation? Depreciation means that if the rupee depreciates, it means that now you have to pay more rupees to buy $1. Okay, previously, for example, if you were paying 60 rupees for $1, okay, now you are paying 65 rupees for $1. It means rupee has depreciated. Okay, so this is the meaning of currency depreciation. Now whenever the currency depreciates, our exports become competitive. Why? Because see, now for foreigners, Indian goods become cheaper, because see, previously with $1, say the exchange rate was 60. So previously with $1, Americans could buy 60 rupees of Indian goods. But now with $1, they can buy 65 rupees of Indian goods. So now, Indian goods are becoming cheaper. Now they can purchase 65 rupees of Indian goods with the same value of their domestic currency. Therefore, our exports become competitive. Our exports are supposed to increase whenever the currency depreciates. Similarly, the reverse will happen whenever the currency appreciates. So currency appreciation means 60 rupees, $1 was the price. Now 55 rupees for $1 is the price of dollar. So our currency has appreciated in this case. And whenever our currency appreciates, our imports become cheaper. Okay, for us, it becomes cheaper to buy American goods or foreign goods. For example, previously we were paying 60 rupees for $1. Now we have to pay only 55 rupees. So we can purchase more imports, right? Because it has become cheaper in terms of rupees. So I hope you have understood this. What is the effect of depreciation on exports and appreciation on imports? So just try to understand. It's a very simple concept. Now see, RBI or we as a country have to balance our trade competitiveness. These both are our goals, right? We have to also keep our exports competitive in the international markets. We have to keep it competitive. At the same time, we have to also ensure that we are able to buy our imports at a cheaper price. So these both are our goals. Okay, so RBI has to balance trade competitiveness with our ability to import. Okay, ability to purchase imports, because see, we are purchasing some essential imports. Essential imports meaning they are not produced in India. For example, crude oil. So crude oil, natural gas, electronics, we have to purchase from abroad. We have to purchase from foreign countries because they are not produced in India. They are not found in India. Therefore, crude oil we have to purchase, we have to import. Electronics also we are importing from outside only. So they so we have some essential imports for our country, and therefore we cannot make our imports very expensive by depreciating or devaluing rupee a lot. Therefore we have to balance this two. Okay, so it is a kind of balance. See, here is one pan of the balance and here is another. So RBI has to balance. This is the export, this is the import. We have to also ensure that our export competitiveness is there. At the same time, we should not pay a lot of money for purchasing our imports. So we have to balance this. Okay, therefore RBI neither allows too much depreciation nor too much appreciation. Okay, so RBI keeps it at a level at which it feels that we are comfortable for our imports. At the same time, our exports are competitive in the international market. So this we have to keep in mind. These are the things which we needed to keep in mind. Now let us jump into the dynamics between interest rate and exchange rate. Okay, now we will study the main topic of this lesson. So the relationship between interest rate and exchange rate is established because of movement of capital in and out of our economy. Now see, we are going to establish the relationship between interest rates, which are denoted by R or I. Okay, so you can use any symbol R or I, and we have to establish the relationship between I and E. Capital E is your exchange rate. Okay, capital E is your exchange rate. So since we are going to look at the relationship between I and E, there should be some connecting link between this. Like whenever we talk about any relation, we say that A is father of B or C is mother of D, like that. So there should be some relation. Now what is the relation? So basically, and how that relation is established, there has to be some reason, right? So basically there has to be some connecting link between these two. Now between the interest rate and exchange rate, the connecting link is the movement of international capital. Okay, the movement of capital, for example, foreign investments. So foreign investments is the major factor, although trade is also there. Okay, so trade, like our exports, okay, our exports, our imports, all these things are also there. But exports and imports are, when you look at the total quantum of money that is that is used in exporting and importing, it is not that much when compared to the capital flows. Okay, capital flows meaning investment in shares, investment in equity, in bonds, external commercial borrowings, etc. So everything in the capital account of balance of payment, that far outweighs the transactions in your current account, that is in the trade. So basically, so that is the reason why the capital movement, they determine our relationship between interest rate and exchange rate. Okay, exchange rate is determined mostly by the capital movement, because trillions of dollars are traded in the capital markets. And when you look at the exports and import, they are just in billions, maybe 20 billion, 40 billion, something 100 billion, around that much. But when you compare billion with trillions, like 100 billion and 100 trillion, so there is 1,000 times difference. So this capital movement is 1,000 times more than the transactions in trade. Therefore the movement of capital, they determine our exchange rate, and they also establish the relationship between our interest rate and exchange rate. Okay, so when foreigners feel that investing in India is profitable, okay, investing in India means what? They will buy Indian shares, okay, shares of Indian companies, then they will invest in Indian bonds. Okay, these Indian bonds can be government securities, they can be treasury bills, okay, they can be corporate debentures, etc. So basically they can also give external commercial borrowing. This is also kind of investment in India. So any type of capital movement is investment, that is considered to be foreign investment. So whenever foreigners feel that investing in India is profitable, they will invest in Indian equity, bonds or other securities. Now this gives rise to increase in demand for rupee. Obviously, see, whenever the foreigners, for example, somebody in America is wanting to invest in India, okay, so in India, the transactions take place in rupee. So they have dollars here. Okay, for example, they have dollar, they will exchange this dollar for rupee, and then they will invest in India. So whenever they want to invest in India, they will demand rupee. Okay, so in the forex market, demand for rupee will increase by exchanging foreign currency for rupee. So whenever rupee demand increases, rupee tends to appreciate. Obviously, see, of anything, if the demand increases, the price will increase. That we know. This is a very well known. You have to keep this in mind, that whenever the demand for anything increases, its price will increase. So if the demand for rupee increases, that means the price of rupee increasing. Price of rupee increases means rupee is appreciating. Okay, the price vis-a-vis foreign currency increases. Therefore, an increase in foreign investment in India will lead to appreciation of rupee. right? If foreign investments increase in India, that means they are demanding more rupee. That means rupee is appreciating. Foreign investment in India will increase when interest rates or bond yields in India increase or interest rates in foreign fall. So when will the foreign investment increase in India? Obviously when our Indian interest rates are more, when they will get more returns on their investment. Okay, when the yields are high. Okay, when the yields are high, returns are high, interest rates are high, obviously at that time only they will invest. Or the interest rates in their country fall. Okay, so for example, if USA, so if the Fed fund, if the Fed fund rates drop, okay, if the US reduces the Fed fund rates, that means the interest rates in the US is less. If the interest rates in US is less, if it is falling, that means, you know, when you compare interest rates in America and interest rates in India, so maybe foreigners will find that investing in India is more profitable because interest rates in India is higher than the interest rates in America. Okay, so whenever the interest rates in foreign falls or the interest rates in India increases, foreign investment in India will increase, right? I'm just trying to establish the dynamics here. Therefore, an increase in interest rate domestically appreciates rupee. Okay, increase in interest rates domestically appreciates rupee. So we have established the relationship between interest rates and exchange rate. So whenever your interest rate increases, exchange rate appreciates. Okay, keep this in mind. Or decrease in interest rate foreign, say USA, appreciates rupee, or otherwise. So foreign interest rates, that is say Fed fund rates, foreign rates if decreases, that also leads to appreciation of rupee. If there is an excessive pressure of appreciation on rupee, now see, for example, if too much of foreign investment is coming in India, because foreigners are suddenly feeling that Indian markets will grow and they're investing a lot in the India, and mostly this investment come in the form of foreign institutional investment, okay, FIIs. If there is an excessive, there will be an excessive pressure of appreciation on rupee because too much capital flows from abroad. RBI will intervene to devalue the rupee. As we have seen in the assumption that RBI has to balance two things. One is it cannot allow too much appreciation, it cannot allow too much depreciation also, because both are harming our interest in one way. So whenever there is too much appreciation, RBI has to intervene to devalue the rupee. Now how will RBI devalue the rupee? Basically, see, devaluing the rupee means what? They have to decrease the value of rupee. Decrease the value of rupee. Now how will we decrease the value of anything? By supplying it more or demanding it less, right? For example, if you want to reduce the price of any commodity, reduce the price of any good, so what is the solution? What are the two ways? One is you increase the supply, or decrease the demand. These are the two ways. And then there is a third way also. There is a third way also. You increase demand for substitute, or against which you are looking for substitute. So you increase the demand for substitute, automatically demand for this will fall. So here what is the substitute for rupee? This is achieved by artificially increasing the demand for foreign currency, dollar. See, decreasing the value of rupee means what? Decreasing the value of rupee means increasing the value of dollar. It always goes hand in hand. If value of rupee is decreasing, it means value of dollar is increasing. So increasing the value of dollar. Now how will you increase the value of dollar? By increasing the demand for dollar. Okay, increasing the demand for dollar. And how will RBI increase the demand for dollar? By buying dollar from the forex market. So RBI buys dollars to increase demand for dollar and thereby appreciates dollar and depreciates rupees. Okay, very simple. So RBI, see, what is the goal of RBI? RBI wants to increase the value of dollar. Increase the value of dollar or decrease the value of rupee. Decrease the value of rupee. This is the goal at this point of time, because rupee is appreciating too much. So we want to do this. Now this will be achieved by what? By increasing the demand for dollar. Increase the demand for dollar or increase the supply of rupee. Supply of rupee. So what will RBI do to achieve this objective? RBI will buy dollar, and whenever it is buying dollar, that means it is selling rupees. So you are selling rupee, that means rupee supply is increasing. You are buying dollar means demand for rupee for dollar is increasing. So this is how it is achieved. Therefore, one of the questions which was asked in the comment section was that whenever there is too much of foreign capital flows in our country, why does RBI buy dollars? So this is the dynamics I have explained it to you, why it buys dollar. So a statement was there that whenever there is too much capital flows or too much foreign investment in the country, it induces RBI to buy dollars. It is buying dollars to save our domestic currency from appreciating too much. Okay, so this is the dynamic. Now, in order to remember this, I have given you one simple diagram. See if you can just keep this in mind. Okay, so see, here is on y-axis. Okay, it is the same as foreign exchange market. Okay, so here on the on the foreign exchange market, the y-axis we have exchange rate. So exchange rate we are defining as rupee per dollar. That means that whenever it increases, it means it means the depreciation of rupee, because increase means more rupee per dollar. Therefore upward means depreciate, downward means appreciate. Okay, and here is the interest rates on the x-axis. This x-axis is common for, and in the on the negative side of y-axis I have put money in the economy. Okay, money in the economy. And so interest rate. So now you just try to look at this particular part. Okay, I'll just show you. Okay, try to look at this market. So this is your normal money market, interest rates versus money. So this is your money demand. This curve, this red curve is your money demand. For example, this is your initial money supply. Okay, this is your initial money supply. Now RBI is increasing the interest rate. Okay, RBI has increased the interest rate. What will happen? Money supply will automatically reduce, because initially the point of intersection was here. Now it has come to here. So your money supply has reduced from Q1 to Q2. Okay, and your interest rates have been increased. Now initially you have to just take this same point on this curve of the exchange rate. See, we have again seen that the relationship between exchange rate and interest rate is such that whenever the interest rates are increasing, your currency will appreciate. Appreciate means it is downward sloping, because downward movement means appreciation. So exchange rates are appreciating as your interest rates are increasing. So in the equilibrium, in the market equilibrium, equilibrium, all the markets should balance each other. So initially this was the point in your domestic money market. This was your equilibrium interest rate. If you take this on this curve, this was your equilibrium exchange rate. Now you increase the interest rate, you come to this point. From this point, you take this to this curve, and now you see this is the equilibrium exchange rate, now E2. So you see that it is appreciating. So you just try to understand the movement whenever you just draw these two line. For example, this is your initial this thing. This was your initial exchange rate. This was your initial interest rate. This was your money supply initial. Now, for example, if your interest rate is decreasing, okay, now it has come here. You take this to this line. This will be your money supply. Bring this here. This will be your new exchange rate. So you see, exchange rate has depreciated. So this is just for your understanding, more understanding. Just if you can remember this simple diagram, you will be able to understand what will happen. Okay, and too much appreciation means naturally RBI will increase the demand for dollars by buying dollars. So I hope this lesson is clear to you now, and you will be able to answer questions asked on this topic. Thank you.